Hi all, welcome to my channel Satish Vlogs. In this video, I would be explaining the concept of sale of goods or services on cash on credit. What is this concept all about? What are the journal entries would get arised when the goods are sold out on cash on credit? How these transactions should get reported or reflected in financial statements? All these details I would be explaining in this video. Okay, in my previous video I had explained the concept of purchase of goods or services on cash on credit. Okay, this is something extension to that video, and also I would be providing the link for that video in the below box. I request the viewers to go through that link before getting into the details of the current video in order to gain the better understanding of the current concept. Okay, when the entity purchases the goods or services, okay, then the purchased goods or inventory would be converted into finished goods, and the finished goods would be sold out in the market in order to generate the sales or revenues. Eventually the profits would get generated. Similarly, when the services are purchased, the value added would be made to the existing services purchased, and the final output of the services would be sold out or rendered to the customers, and the revenues would get generated, right? So with this introduction, let's move to the next slide of my video. In this video there is a diagram which depicts like a cycle. This is nothing but the accounting cycle. What is an accounting cycle? What are the phases of an accounting cycle? All those details I had already shared in my previous video on accounting cycle. I would be providing the link for that video in the below box. I request the viewers to go through that link before getting into the details of the current video in order to gain better understanding of the current concept. Okay? And also, as mentioned previously, I would be explaining my concept considering the phases of an accounting cycle. So as part of an accounting cycle, what is the first phase? The first phase is business transaction, and sale of goods or services on cash on credit is a business transaction. Okay, the sale of goods or rendering of the services might happen on cash basis or on credit basis. What are the journal entries if the sale of goods happens on cash basis or credit basis? All those details I would be explaining as part of the second phase of an accounting cycle. Now let's move to the second phase of an accounting cycle. The second phase is a generalizing phase. What is this generalizing phase all about? For whatever the business transaction, how the journal entries would get created, all these details I would be explaining. Okay, when the goods are sold out on cash basis, normally sales is a nominal account. What is the golden rule for a nominal account? Debit all expenses and losses, credit all incomes and gains, right? So as per this golden rule, as sales being a nominal account, they should be credited, right? Because the income would get generated to the business entity when the goods are sold out, right? So this needs to be credited, right, to sales. However, to which account we are supposed to be debited? The business entity will not doesn't give the goods at a free of cost, right, or services at a free of cost, right? The goods would be sold out for some consideration, right? That consideration could be bank or cash. So bank or cash accounted are to sales account, right, when the goods are sold on cash basis. What if the goods are sold on credit basis? The credit would be given to the sales account. However, the debit is supposed to be given to the sundry debtors or accounts receivable account, because the business entity will not be receiving the bank or cash immediately from the from to whom the goods are being sold out, right? Because there will be the amount would be received after some due date. So till that point of time, the amount is required to be parked against some account which is against the person from whom the revenues are supposed to be received. So that person is nothing but the sundry debtors or accounts receivable account. Okay. So the entry would be sundry debtors or accounts receivable account debtor to sales account. Okay. Hope this is clear. Now let's move to the third phase of an accounting cycle, which is a ledger postings phase. What is this phase all about? For whatever the journal entries which were created as part of second phase of an accounting cycle, okay, for all those journal entries, ledger accounts are supposed to be created and the entries are required to be posted accordingly in the respective ledger accounts. Okay. So what were the accounts against which the journal entries were created as part of journalizing phase? One is the sales account and the other one is the bank account or sundry debtors account or accounts receivable account, right? So for these accounts, ledger accounts are required to be created as part of ledger posting phase and entries are required to be posted accordingly. Hope this is clear. Now let's move to the fourth phase of an accounting cycle, which is a trial balance phase. What is this phase all about? This is nothing but the summary of the balances of the ledger accounts. So whatever the ledger accounts which were created in under third phase of an accounting cycle, for which the account balances are supposed to be updated in the trial balance, right? So there were three accounts for which the ledger accounts were being created as part of ledger posting phase. What are there? One is the bank account and the other one is the sales account and the last one is the sundry debtors account or accounts receivable if the goods are sold on credit basis. So the balances for these accounts are required to be updated in the trial balance accordingly, right? Okay. So whatever the balances which are getting reflected under the debit side of the trial balance should matches up with the balances which are getting reflected under credit side of the balances. There shouldn't be any discrepancies between debits and credits, because as we have been following double entry system of bookkeeping of accounting, there shouldn't be any differences or discrepancy between debits and credits. Now let's move to the last phase of an accounting cycle, which is financial statements phase. What are the critical statements which forms part of the financial statement? One is the income statement and the second would be the balance sheet. Okay. So how the balances would get reflected in the financial statements? The balances would are required to be updated considering the balances which are available in the trial balance. Okay. So the balance, the account balance for the sales account is required to be updated as a income in the income statement, because as this sales would fall under the nominal account and which is an income to the business entity. So the business, the whatever the incomes are getting generated, it needs to be created right in the income statement. So it, the income which is going to get generated from the sales needs to be created to the income statement. What are the other accounts which are lying in the trial balance? One is the bank account or sundry debtors or accounts receivable. Okay. So organization or business entity is supposed to receive the money, right? So the bank is supposed to get reported under the current assets in the balance sheet, and the sundry debtors are supposed to be reported under the current assets in the balance sheet, because the entity would end up in receiving the money from the sundry debtors. So due to that reason, it would get reported under current assets in the balance sheet. Okay. There shouldn't be any differences under debit side of the balance sheet between versus the credit, the balances which is getting reflected or reported under credit side of the balance sheet. There shouldn't be any discrepancy. The balances should get matches up, because as we have been following double entry system of bookkeeping, ideally there shouldn't be any difference between the balances which are getting reported under debit side of the balance sheet versus balances which are getting reported under credit side of the balance sheet. Hope this is clear. With this, I hope the viewers are able to understand what is the sale of goods or services on cash or credit all about, what are the general entries which get arises out of this transaction, how this transaction should get reflected or reported in financial statements, all these details. Okay. If the viewers like this video, request you to like it, share it to your friends and subscribe my channel for more videos. Thanks for watching. Catch you in the next video. Hi all, welcome to my channel Satish Vlogs. In this video, I would be explaining the concept of a sales returns. What is this sales returns? What are the journal entries when the sales returns are made? How these sales returns are supposed to be reported in financial statements? All these details I would be explaining in this video. With this introduction, now let's move to the next slide of my PPT. In this slide, there is a diagram which depicts like a cycle. This is nothing but an accounting cycle. What is an accounting cycle? What are the various phases of an accounting cycle? All those details I had already provided in my previous video on accounting cycle. And also, these sales returns are related to or pertains to the sales, right? So for that reason, details related to the sale of goods or services on cash or credit, details regarding to this concept were already been shared in my video. Okay, and I would be providing the links for these two videos in the below box. Request the viewers to go through the details of those two videos before getting into the details of the current video in order to gain better understanding of the current concept on sales returns. As mentioned, I would be explaining my concepts considering the phases of an accounting cycle. As a first phase, which is a business transaction, my business transaction is sales returns. Okay, in which circumstances the business entity would end up in receiving the inventory back from our buyers. There could be possibility that the defectives might got delivered at the inception when the sales were made, or if there were any rejected pieces were sold out by our sales department to our buyers or customers, or if the sales are not up to the mark as per the conditions which are being predefined by the buyer, then in such a case our business entity might expect the sales returns from our buyers, right? So whatever the returns which are being received, we need to treat them as a sales returns. So with this, I hope the viewers are able to understand what the sales returns are all about. Now let's move to the next phase of an accounting cycle, which is a journalizing phase. What is this phase all about? For whatever the business transaction for which the journal entries are supposed to be recorded, right? So what is the sales returns are about? The business entity would receive back the goods which were sold inceptionally or initially, right? So when the goods are sold on cash, then in such a case our business entity is supposed to refund back the cash to the extent of the sales returns which are being made by the buyer, right? When the sales are made initially, then what would be the entry we might have already made? We might have made bank account data to sales if the sales were made on cash basis. Then now, as we have been receiving back our inventory, then in such a case we need to reduce our cash sales to the extent of the returns we have received now. So which means our sales is supposed to be reversed out to the extent of the sales returns we have received now. Sales account data to bank, right? If the sales were made on cash basis and the returns would be receiving now. Okay. However, where the sales were made on a credit basis and we would be end up in receiving the sales returns now, then in such a case we might have debited our sundry debtors or accounts receivable account, right? And we might have given credit to sales account. Now we need to reduce our sales to the extent of the sales returns which are being made by our buyer, right? So which means the sales needs to be reduced, which means the we might have initially credited our sales account. Now we need to debit our sales account in order to reduce our sales to the extent of the sales returns we have received now. So sales account debtor to sundry debtors are accounts receivable, right? Hope the viewers are clear how the journal entries are supposed to be made for sales returns. Now let's move to the third phase of an accounting cycle, which is ledger postings phase, right? So what is this phase all about? For whatever the journal entries which were recorded as part of journalizing phase, for which the ledger accounts are supposed to be created and the posting needs to be done or entries needs to be posted accordingly, right? Yeah. So we might have already created the sales account and bank account and sundry debtors account, right? Now we are receiving back our goods as a sales returns from our customers, right? So we need to reduce our sales to the extent of the sales returns we have received now, which means we need to adjust our sales, right? So basis on the entries we have made as part of the journalizing phase, those entries are supposed to be posted in the respective ledger accounts. Hope this is clear. Now let's move to the fourth phase of an accounting cycle, which is a trial balance phase. What is this phase all about? For whatever this trial balance is nothing but the summary of the balances of the ledger account. So as the balances against sales, bank, and even the sundry debtors are already available, whatever the balances which are getting reflected as part of the ledger accounts, those balances are supposed to be updated in the trial balance, right? So the balances which are shown under the debit side of the trial balance should matches up with the balances which are shown under credit side of the trial balance, because as we have been following double entry system of bookkeeping, there shouldn't be any discrepancy in balances, and the debits should tie back with the amounts which are shown on the credit side. Okay, with this let's move to the last phase of an accounting cycle, which is a financial statements phase. The critical statements of the financial statements are, one is the income statement and the other one is the balance sheet. Okay, so as mentioned already, we need to adjust our sales, right? Which means it might impact our income statement, right? We might have initially credited our sales in the income statement. Now as we are receiving back our goods which were already sold in the past, right? Now we need to reduce our sales to the extent of the sales returns we would be receiving now, right? Yeah. So adjust the amount accordingly. And in the balance sheet, the balances against the bank account and the sundry debtors accounts are required to be updated, and we would be updating the details in the financial statements as per the balances which are available in the trial balance, right? Yeah. With this, I hope the viewers are able to understand what these sales returns all about, in which circumstances normally the sales returns would happen, and what are the journal entries when in case of the sales returns, how the sales returns are supposed to be reported in financial statements, all these details. Okay, if the viewers like this video, request you to like it, share it to your friends, and subscribe my channel for more videos. Thanks for watching. Catch you in the next video. Hi all, welcome to my channel Satish Vlogs. In this video, I would be explaining the concept of a bills receivable. What is this bills receivable all about? What are the journal entries when the bills receivable has been accepted? How these bills receivable should get reflected or reported in the financial statements? All these details I would be providing in this video. With this introduction, let's move to the next slide of my PPT. In this slide, there is a diagram which depicts like a cycle. This is nothing but an accounting cycle. What is an accounting cycle? What are the various phases of an accounting cycle? All those details I had already provided in my previous video on accounting cycle. And the concept of bills receivable primarily arises when the business entity sells the goods or services on credit basis. What is this concept all about, and the details related to this concept I had already shared in my previous video on sale of goods or services on credit basis, and the links for these two videos I would be providing in the below box. Request the viewers to go through those two videos before getting into the details of the current video in order to gain a better understanding of the current concept on bills receivable. As mentioned previously, I would be considering the phases of an accounting cycle to explain my concepts. Okay, so as part of the first phase, which is a business transaction, accepting bills receivable is my business transaction. Basically, bills receivable is a negotiable instrument. There are two parties to this negotiable instrument or bills receivable. One is the drawer and the other one is the drawee. Drawer normally is a seller who is the person who draws the instrument on the drawee. Drawee is nothing but the buyer, and drawee accepts that bills receivable and return backs the same to the seller. And there will be a due date which has been mentioned on the face of the bills receivable. On the due date, the drawee pays the amount to the seller or drawer. That there is no need to involve intermediaries like financial institutions in order to manage this bills receivable. Okay, bills receivable can be discounted by the drawer. Bills receivable can be endorsed, which means it can be transferred to the third party, and the third party would be called as a bearer of the instrument. On the due date, the amount would be directly paid by the drawee to the bearer of the instrument. Because of these prominent features, this bills receivable has been widely accepted during the process of the business transactions. Okay, so now with this, let's move to the next phase of an accounting cycle, which is a generalizing phase. This bills receivable would be primarily arised because of the credit sale of the goods or services. So the amount has already been parked against sundry debtors. Now the amount needs to be reclassed from the sundry debtors to bills receivable account. So the bills receivable is supposed to be debited and the credit needs to be given to the sundry debtors account. Okay, so hope this is clear. Now let's move to the third phase of an accounting cycle, which is a ledger posting or creation phase. What is this phase all about? For whatever the journal entries which were made as part of the generalizing phase, for those the ledger accounts are supposed to be created and the entries are supposed to be posted accordingly. So the entries are required to be posted against bills receivable account, and the sundry debtors needs to be reduced to that extent as that account might have already been opened in the might have already been created in our accounting books. Okay, now let's move to the fourth phase of an accounting cycle, which is a trial balance phase. Trial balance is nothing but the summary of the balances of the ledger accounts. So the balances for the bills receivable and the sundry debtors are required to be updated in the trial balance, and the balances under the debit side of the trial balance should matches up with the balances under the credit side of the trial balance. There shouldn't be any discrepancy between debits and credits, because as we have been following double entry system of bookkeeping, ideally there shouldn't be any differences between debits and credits. Now let's move to the last phase of an accounting cycle, which is a financial statements phase. What are the critical financial statements? What are the critical statements forming part of the financial statement? One is the income statement and the other one is the balance sheet. There will not be any entry in the income statement because it doesn't impact my income statement. So the balances against the bills receivable is supposed to get updated under current assets in the asset side of the balance sheet, and the balance against the sundry debtors needs to be updated or reduced to that extent from the existing sundry debtors. Okay, this is how it is supposed to be shown or reported in financial statements. With this, I hope the viewers are able to understand what is this bills receivable all about, what are the general entries when the bills receivable are being accepted, how this bills receivable should get reflected or reported in financial statements, all these details. If the viewers like this video, request you to like it, share it to your friends and subscribe my channel for more videos. Thanks for watching. Catch you in the next video.